Teck Resources delivered a mixed quarter. The stock is seeing some pressure despite earnings beating expectations on lower costs and steady improvement at their QB project in Chile. We are joined now by Craig Hutchison, Director and Base Metals Analyst Equity Research at TD Securities, to help break down the results and what they signal for 2026, which will be an interesting year for them. Craig, thanks as always for joining us. What stands out for you from these numbers?
Yeah, thanks for having me on the show. Yeah, we actually thought it was a pretty good print for the quarter. Earnings was a beat. Came in at $1.5 billion. Consensus going into the quarter was around $1.4 billion. There weren't a tremendous amount of surprises this quarter around. We already have the production numbers for Q4, so no surprises on the production front. The company also reiterated their guidance on the production for the next 3 years, so no big issues there. They gave some pretty positive indications that the QB mine is starting to operate a bit better now. It's starting to ramp up. It's starting to kind of get its stride. They feel confident that they can exit this year close to design. I think maybe one of the issues and where maybe people have some concerns or why the stock is weak today is the overall capital budget for this year is quite high. It's in that $3 to $4 billion range. So this year they won't be generating a lot of free cash flow at the current prices, just based on that spend. It should roll off next year. This is supposed to be a peak year from a capital perspective. I think that's perhaps why some investors are selling stock today.
Is it looking like money well spent, that cap budget?
It's money they have to spend. There's some major projects they have to do. One of them is the Highland Valley extension. It's a project. It's a major pushback of the pit that'll extend the mine life into the 2040s. If they weren't spending that capital, the mine would effectively run out of ore by the end of this decade. So that's obviously money they need to spend. And the issues that they've had at QB for the last few years require a lot of work on the tailings management facility, which is what they're spending a lot of money on this year. So I think as you look into next year, you should see the benefit of the capital spend in terms of the production growth.
All right, and those lower than expected costs, how important were they for the beat?
They're kind of marginally important, I would say. I mean, I think a lot of the beat really came more from the kind of the top line. They had some very positive provisional pricing adjustments in the quarter. I think looking forward, the guidance for this year, there is potential to beat the guidance that they've issued. A lot of the companies out there are using, I would say, conservative precious metal prices, but they're using precious metal prices that are below current spot prices. So if precious metals prices hold up and some of these byproducts remain very strong, I think you have the potential that they could actually beat their cash guidance this year.
And any concerns if we see a downturn in those prices, how much of an impact that would have?
Yeah, obviously it would go the other way. If we saw prices for copper pull back, you're going to see an impact on the revenue and the margin side of the business. And also we see the precious metals and some of the byproduct credits, those prices retreat. That'll obviously put some pressure on their C1 cash costs for the year.
But also, I mean, it's something they can weather though too.
Yeah, their liquidity is in a really strong position. I think they're in a net cash position, like over $5 billion of cash and liquidity of over $9 billion. So they're in a very good position right now financially to weather the storm and certainly execute on their capital plan this year.
All right, and your rating as a whole, target price is $76. What's keeping you on the sidelines?
Yeah, so we downgraded the stock in mid-January. It was after a really strong Q4. The stock was up quite substantially when we downgraded it. It really is more to the fact that we think the stock could trade sideways as they ramp up the QB operation. There's also, I say, a little bit of uncertainty with regard to the timing of the close with the Anglo-American deal. We think that could happen in September, but there's possibilities that could get pushed out into next year. They still need a couple approvals from the South Korean government, the Chinese government. We just saw at the time, we saw better value in terms of some of the other names that were trading at a bigger discount to Teck. So I do like the long-term growth story at Teck. I think they are doing the right things. They seem to be gaining momentum here at QB. It was just more at the time a valuation call where we thought the stock might just sort of trade sideways.
And with the Anglo-American deal, is that just kind of humming along now, even though, and would it be a huge factor if it got pushed back into 2027, or is it something not a lot of people would be surprised at?
So when they announced it last year, they allowed for a 12 to 18 month close. So I think a 12-month close would put you around September this year. They've got most of the key approvals at this point. They've got EU approvals, Canadian approvals, US approvals. So most of the main jurisdictions, they're just waiting on, really, I think it's 2 at this point, South Korea, and just takes longer to get those approvals just based on returns from the government.
And just one last question, the latest on the Chilean mine?
Sorry?
The Chilean mine?
QB?
Yeah, is that QB? Sorry.
Yeah, sorry. The question
we were talking about,
on delays?
Sorry, one more time.
Sorry, what was it? The question was on QB?
Yeah, you mentioned about the cyclones and shipload. Did you touch on the cyclones and shiploader repairs are all complete?
Yeah, so they made a lot of progress in the last quarter. The ship loading repairs are now done. They've swapped out all the cyclones at QB. So what that allows them to get a faster deposition rate of the sand, and they could basically build the tailings management facility raises. The ultimate goal really here is to have the tailings dam complete by the end of this year so that they can move to a permanent infrastructure. So the process will be much quicker in terms of future raises of the tailings dams. And that'll allow the upstream part of the process to match the downstream. And the bottleneck really has been on the downstream for the last couple of years. And by the end of this year, they hope to have all the issues with the tailings management facility complete, and then they can run the mill at its full optimal design capacity.
All right, we'll wrap it up there. Craig, thanks very much for joining us.
Yeah, thanks for having me.
Craig Hutchison is Director and Base Metals Analyst at Equity Research at TD Securities.